Hello friends, Terry Smith bought Texas Instruments stock last quarter, and it was the largest addition to his stock portfolio during that time. This new investment immediately accounted for almost 0.8% of his portfolio. If one of the greatest investors out there, often referred to as the English Warren Buffett, shows a lot of conviction in a certain company, it may be worth taking a closer look at it to see if it could also be an interesting investment opportunity for us. So let's start with the recent financial results, and they are not good. Revenue is down by 16.4% year over year, net income is down by 35.3%, cash is also down by 16.2% in 3 months, and debt is up by 20.8% in that time. Okay, so short-term results are bad. I mean, really bad. But as investors, we should be looking at the long term. So let's do that. If you were to invest $1,000 into this company 10 years ago, you could buy around 22 shares. And now they would be worth something close to $4,290. And this company also pays dividends, so in that time you would get $701 as dividends. So if we add those numbers together, we get $4,991, and that is a total gain of 399% in 10 years. That is very good. But let's analyze the company itself to see, is there a chance to continue such a trend into the future? Individual insiders, that is an X. 0.2% of the company is owned by individual insiders, and we would like to see it over 2%. So the management does not have a lot of skin in the game. And are individual insiders buying? That is an X. In the last year, they sold shares worth over $100 million. And the super investors own this company. That is a check. 8 super investors own shares of Texas Instruments, including people like Christopher Davis, David Katz, and since last quarter, Terry Smith. And are they buying right now? That is a check. In the last quarter, they bought over 1,100,000 shares and sold just over 250,000 shares. So a lot of conviction from super investors. Return on invested capital, that is a check at 30.2% 10-year median returns. That shows that the management is doing a very good job. But Mr. Haviv Ilan is the CEO of Texas Instruments Incorporated only since April 2023, so those results are not really created by him. And in the last year, they are getting worse. But there may be a reason for that, and we will get to it. And what do we know about net profit margin? It is a check at 35.2%, and the industry average is 16.5%. So Texas Instruments is one of the best companies in the industry when it comes to the profit margin. And now let's take a look at share buyback. It is a check. In the last 10 years, they bought back 15.7% of shares. That is very nice. What it means is that long-term investors don't have to spend any extra money to own a bigger portion of this business. And the debt? It is an X. It would take 2.6 years to pay the long-term debt with a 5-year average free cash flow. If we would look at the recent free cash flow, the result would be much worse. Revenue growth, that is an X at 3.7% 10-year compound annual growth rate, and we would like to see this number higher than 10%. But the main reason for the result is a sudden drop of revenue in 2023. Free cash flow growth, that is an X at minus 7.6% in the last 10 years. So that is not good. But this lower free cash flow can indicate a lot of investments and R&D costs. We know, for example, that Texas Instruments is building 2 new assembly and test facilities in Malaysia and also a new production plant in Utah, which is worth $11 billion. So the recent bad financial results are at least in part triggered by investments that are necessary to secure the future of this company. And earnings per share growth, that is a check at 14% in the last 10 years. So the share buyback program is doing its job. There are less shares, so earnings per share are higher. The dividend yield is 2.7%, so shareholders can expect to get $5.20 annually from every share. And the payout ratio, that is an X at 79.3%. And we want to see the payout ratio somewhere between 20 and 50%. So what it means is that this company is spending almost 80% of its earnings to pay dividends. That is not healthy. If they would cut the dividends, they could, for example, have a much smaller debt. But it seems that the management has a different idea for the future of this company when it comes to dividends. So let's look at the dividend growth. It is a check at 11.9% 5-year growth rate, and they are growing their dividends for 18 years. So it seems they intend to become a dividend aristocrat in the next few years. Interesting. Price to earnings ratio is 30.3. That indicates that Texas Instruments is rather expensive right now. But to properly value this company, we will use a discounted cash flow formula and we will create 3 scenarios of its future growth. We will also use a 5-year average free cash flow for this calculation instead of the most recent one, because it is much lower than what we observed in the last few years. The decrease is largely influenced by substantial investments. Therefore, the 5-year average free cash flow likely represents the company more realistically. So, in the low scenario, we will estimate a growth of 10% for the next 5 years and then 8%. In the medium, 14% and then 12%, and in the high scenario, 16% and then 14% growth. So the low scenario is a bit lower than the predicted average growth for the semiconductor industry, which is around 14.9%. Medium is very close to the predicted growth of the industry, and the high one is showing a scenario in which Texas Instruments grows just a bit faster than the competitors. So, with such estimates, the intrinsic value in the low scenario is $105, in the medium $144, and in the high scenario $169. But we have to always apply a margin of safety to those prices. I use a 30% one. And with such a margin, we get in the low scenario $73, in the medium $101, and in the high one $118. And the current price is around $197. So it is all in the red. Texas Instruments is rather expensive right now. Okay, so now let's go to our Stock Ranking Pro and get an overview of this company. So here are all the data we just talked about, and here we get to our scores. And if we sort the ranking by financial health, we see that Texas Instruments has the 9th best financial health of all the companies we analyzed on this channel. And when we look at the company overview, we see straight away that it is not a fast-growing company. It's healthy, it has nice dividends, and a decent situation when it comes to investors. But growth is disappointing. So what is the bear case for Texas Instruments? Well, the new CEO may not be able to turn this ship around. Current investments may pull this company so far down that it will really struggle to get back to the strong position it was at just recently. Also, this industry has some very strong competition. Companies like Nvidia, AMD, Intel. So to actually grow faster than those companies will not be easy. And the technology shifts that are coming with AI, self-driving and other new technologies can be very hard to navigate. So it is not a business that runs itself. And let's not forget that at the current price, it does not look like a bargain. And what is the bull case? Well, after a year or two of worse results, mainly due to huge investments, Texas Instruments may emerge as a strong and dangerous competitor to all the major players in the semiconductor industry. The fact that they have one of the highest margins in the industry can allow them to strengthen that position. And the company serves various industries, including automotive, industrial, and consumer electronics. These markets provide different revenue streams, so they are well diversified. Also, they may continue growing the dividend and in few years become a dividend aristocrat. And if they also continue to buy back shares, then they can create great returns for long-term investors. If you enjoyed this video, check out my analysis of Super Microcomputer Incorporated or TSMC's analysis. I think you may like them. Thank you so much for watching and see you in the next one.